Hi guys, welcome to week 10 in finance for the sport and recreation industry. This week we're looking at what we call CVP analysis. You might have maybe had a quick look at that in some of your other subjects perhaps. It's a fairly straightforward lecture this week, which is good. I know you've got a lot of assignments due and everything else, and as always we'll practice these questions in tutorials to give you the best opportunity to understand what we are talking about. Okay, so I'm just going to share my screen and then we can get onto it. Okay, so this week, like I said, week 10, and we're talking about cost, volume, profit analysis. Okay, alrighty. Essentially, we're going to be talking about cost accounting. So that means we're going to be talking about direct and indirect costs. We're going to have a little time on opportunity cost. We're going to talk about fixed and variable cost, and then some cost allocation methods, okay? So cost accounting measures and reports information related to the cost of acquiring and utilizing resources. It provides information for management and financial accounting. Management to help them manage the business better. Financial accounting, it helps them determine things such as the value of, say, inventory, work in progress, okay? So cost management describes the approaches and activities of management in short run and long run planning. Now, these decisions increase the value of customers and lower the cost of products. So what we're talking about there is if we can not spend money on costs that don't add value to customers, that's going to be a good thing. It's going to, A, keep the customers happy because they're only paying for what they wanted. And it means that we're not going to waste time on reworking goods, which might mean the customer has to return a product. And at the end of the day, it's going to save us cost and it's going to save us money, okay? So a cost is incurred when a firm uses a resource for some purpose. And costs are assembled into meaningful group called cost pools. So it could be a type of cost, say different types of labor maybe, or coming from the same source, okay? Any factor that has the effect of changing the level of total cost is called a cost driver, okay? So something that drives cost. So for example, the total cost of flour used in a bakery, the cost driver may be the number of bread rolls baked or the number of loaves of bread. A cost object is a product, service, etc., to which costs are assigned. So in that case, the cost objects could be bread rolls, and the cost being allocated, okay, or the cost being allocated to it are the flour, water, yeast, okay, and the cost driver could be the number of units produced. So like I said, a cost is a resource sacrificed or foregone to achieve a specific objective. And a cost object is any product, machine, service, or process for which cost information is accumulated. So cost objects can vary for entire company to a division or even a single product or service, okay? So a cost object is any machine, any level of production or any unit or anything we produced for which cost information is accumulated or accounted for, okay? A direct cost is a cost which is related to a particular cost object and can easily be traced. So we might be looking at the loaves of bread, and we can easily trace that, you know, we use $2 worth of flour in every large loaf of bread, and we can trace that because we know that is the case, okay? An indirect cost is a cost which is related to a particular cost object but can't be traced in an economically feasible manner. So we might have ovens that bake millions of loaves of bread and bread rolls and croissants and all those things, and it might use oil, but it only uses a little bit of oil, and so it's not really feasible to work out how much oil is consumed by the machine for every loaf of bread or for every bread roll, because you might be saying we produce 1 million loaves of bread a year and I'm trying to allocate oil cost of $100. Just not feasible to spend that time trying to allocate that cost. So we would just call that an indirect cost, and we tend to allocate them in cost pools where we put all the indirect costs, and we might just work out an arbitrary type of figure. We might say, well, there's $1 million worth of indirect costs for the year. We bake 1 million loaves of bread, so we're just going to say that our indirect cost per loaf of bread is $1. Now, you might have a situation where some loaves use more, some loaves use less, but we don't go to that level of detail usually. So a cost driver is a factor which causes the amount of cost incurred to change. So it could be production, could be labor, could be the number of units. So production costs are driven, for example, by the number of units produced, labor costs, the number of setups, and even the number of changes in order. Okay, so they're cost drivers. Now, it's really important for a company to understand cost drivers, because there's a couple of things here. You can't manage your costs if you don't know what your costs are, and you can't manage your costs if you don't know what drives your costs. So that's why cost drivers are so important. Okay, cost reduction programs, they tend to focus on two things. We only want to do value-added activities, things that people are prepared to pay for. So for example, if someone left a tap on and there was a flood in your production process and it cost you $10,000 to get things back up and running, that doesn't have a value to a customer. They're not interested. They wouldn't want to pay you for it, okay? So we want to efficiently manage the use of cost drivers to making sure that any costs that are incurred only add value to our customers, okay? With this in mind, we often talk about what we call variable costs and fixed costs. A variable cost, which is constant per unit, but changes in total in proportion to changes in output. So as output goes up, total variable cost goes up, but the cost per unit stays the same. So it could be a dollar for flour per loaf of bread. If I make 10 loaves, it's $10. If I make 100 loaves, it's $100. It's still $1 per unit, but total cost goes up as the number of units produced goes up, okay? A cost which does not change in total is volume changes, but changes on a per unit basis, okay, is a fixed cost. So if I've got rent of $1,000 a week, if I make 1 loaf of bread, that's $1,000 per loaf of fixed costs. If I make 1,000 loaves of bread, it's $1 of fixed cost per loaf. If I make 10,000 loaves of bread, it's 10 cents per loaf of bread, okay? So fixed costs go down per unit as the number of units produced goes up, but fixed costs tend to stay, or they do stay fixed. Things like rent. You don't pay different rent because you produce a different number of units. So let's have a look at this example. The Coastal Jellyfish AFL Club are considering raising funds by running an evening of entertainment where one of the players is seated at each table. Revenues and costs are as follows. Expected ticket sales are 300. The price per ticket is $110. The variable costs are $30, and the fixed costs are $21,000. So the variable cost is we sell more tickets, we incur more meal cost, but the cost of the hall and the band, doesn't matter how many tickets we sell, they're going to be charging us $21,000. Okay. So from this we can say revenue was 33,000. Variable cost was 300 tickets times $30 a ticket for the meal is $9,000. So revenue minus variable cost is contribution margin, less the fixed costs gives us whether there was a surplus or a deficit. And in this case, it was a surplus, okay? The break-even point is the point at which a business or activity within a business does not make a deficit or a loss, is called the break-even point. It's where the profit is equal to zero. Now, this should be the worst case scenario because you don't want to ever make a loss, okay? And we can work it out from the following formula. Sales price times volume, so that'd be total revenue, minus variable costs times volume, which would be total variable costs, less fixed costs should be equal to zero. So we can use a formula and say SP, which is sales price times volume, times variable cost times volume minus fixed costs. So using our formula, we can say that 110 was our selling price per ticket times V, which we don't know, minus 30 times V, minus 21,000 is equal to zero. So 110V minus 30V minus 21,000. Break even is when that equals zero. 110V minus 30V is 80V. Minus 21,000 is equal to zero. Do a bit of rearranging and say 80V is equal to 21,000. V, therefore, is equal to 21,000 divided by 80. So what that means is we need to sell 263 tickets in order for us to break even. Why do we use break even? It can help allow us to understand what price we should charge for a good, how many we need to sell, or what volume we need to target in terms of selling. And it could also help us analyze our cost structures as well. Okay. Last couple of issues. The margin of safety is the decrease in volume that a business or activity can withstand without making a loss. So the margin of safety is usually the difference between the budgeted amount, and the break even. So budgeted minus break even over budgeted, we can do it for units. 300 is what we expected to sell. 263 was the break even. The difference there is 37 units divided by the budget. So that says we've got a 12% margin of safety. Obviously, the higher the better. In units, this means that we expect to sell 300. We can sell as low as 263. So we've got a 37 unit margin safety, okay? Economics is the study of how individuals and economies deal with problems of scarcity, okay? As a result of scarcity, individuals and societies must make choices amongst competing alternatives. The opportunity cost of any alternative is defined as the cost of not selecting the best alternative. So let me give an example. If I could earn $10 an hour at work and I could work 24 hours a day, 7 days a week, okay? So it's $10 an hour. I would say that the opportunity cost of my leisure is $10. Why? I'm giving up $10 to be able to partake in the next best activity, which is my leisure. Okay, that's a kind of a simple, easy to understand example. So guys, we've been through pretty easily understood concept today, I think. I think a lot of people have a good understanding of what it means to break even, what fixed costs are, what variable costs are. I know it's a busy time for you. There's a lot of assignments due. That's why we kind of put this topic here so that we can still learn about the topic, but we can also devote some time during our studies to making sure that we get those assignments done as well. Okay. Well, thanks very much for your time. I hope you've enjoyed it. And I will talk to you next time. If you've got any questions, as always, keep in touch. Thanks very much, guys. Have a great day.